20% of Africa's population survives on over $20 per day. Now, this is promising if mortgage systems make it more affordable for Africans to own their own homes. One solution for this is seen to be microfinance institutions that entering the housing market. Equity analyst at Sanlam Investments, Patrice Rousseau, joining us for more on unpacking potential opportunities for unsecured lenders to tap into the opportunities that housing presents, perhaps in South Africa. In Africa, it's all about affordable housing. Is this an untapped area that the unsecured lenders could look to for growth, Patrice?
Yeah, that's quite an interesting question because the only unsecured lender who's stated that they would look at entering this area has been Capitec, which felt that they could compete with the secured lenders. One has got to bear in mind that a lot of the traditional banks also have been involved in the affordable housing area. ABSA, for instance, have been able to get involved in the property development stage and sort of also been quite aggressive there. And FNB have made it quite clear that they were seeing a lot of growth in the affordable housing area. So I don't think that it's an area which is untapped as such, and it remains to be seen whether with an unsecured loan you'd be as competitive as someone who was going to lend against the security of property. So I would say at this point in time, it still remains the domain of the traditional banks.
And of course, so when we're talking about unsecured loans, they always come with higher interest rates. So you've got to question whether that might offset the gains you would get from just being able to access that loan in the first place.
Yeah, there's a definite issue of affordability because unsecured loans are obviously coming at much higher interest rates, you know, maybe sometimes twice the level of interest rates you would get for an affordable housing loan. The other issue is also, and it's something which has been discussed within the code of practice within the banking community, is that whether you should really give someone who wants a secure loan against an asset, whether it's property or a vehicle, whether you should be satisfying that credit need by means of an unsecured loan, which comes a lot more expensive. And I think there's also a bit of an ethical issue here at play. And one of the recent agreements between the lenders and the regulator has been that unsecured lending would be to satisfy other needs, not to finance asset as such. So that's the state of play at this point in time.
Let's talk about, how attractive this space is for banks in general, because if you just look at some of the housing price movements we've seen, average price of small homes in South Africa rising from just almost 661,000 in the first quarter of 2011 to 773.3 thousand in the fourth quarter of 2012. Basically, we've seen an uptick in the price of small houses in South Africa in the affordable housing space as well. Is this why banks are seeing opportunities here?
Yes, I think it's a situation of having very limited supply and a lot of demand. If you look at where there's been large real wage increases, it's been at the lower LSM level. A lot of the public servants have been able to benefit from fairly solid double-digit disposable income increases thanks to good wage increases above inflation. And there's a number of newcomers who want to get on the housing ladder, and that's the way to start would be in the sort of lower end of the market, and this is why it's so buoyant. And definitely the banks have noticed that and are playing in that area, but it's one where, as they say themselves, demand exceeds supply. So that's why you're seeing the type of price increases you mentioned earlier.
Banks overall, I suppose, are struggling with the credit boom of the property bubble, I suppose you could call it that, in prior years, 2005, around that period. And we've seen mortgage lending really tepid. The latest figures, 0.3% up month on month for the month of May. So banks really aren't aggressive in the lending in the mortgage space as it is right now, though.
Yes, I think the issue that you touch on is the type of de-gearing of the traditional customer that you would have expected hasn't taken place. And the reason for that is while you had an over-indebted customer and debt to disposable income shot through the 70% type of level, you initially had a bit of de-gearing, which was helped by the lower interest rates. But subsequent to that, you had some of these customers who went out and took on unsecured debt at much higher interest rates, which means that on an overall macro level, the debt to disposable income type of burden hasn't really shifted, because the cheaper secured debt has been replaced by maybe smaller but more expensive unsecured debt. So we haven't seen the type of de-gearing that we've seen, let's say, in the first world, in the case of the American consumer, for instance, where there's been massive de-gearing taking place.